You know that feeling, right? You've got all the info articles, alerts buzzing,
Right.
maybe even a plan right there on your desk.
Mm-hmm.
But then when it's actually time to make a money decision, you still feel that, I don't know, confusion, maybe even a bit of fear.
Oh, definitely. And the decision you actually make doesn't always line up with what you know.
Exactly. It feels questionable later sometimes, let's be honest.
Well, that gap, between the knowing and the doing, that's incredibly common. It's just part of being human, really.
Absolutely. And that disconnect, that specific feeling, is exactly what we're diving into today.
We're pulling from Carl Richards' book, The Behavior Gap. Great title.
Isn't it? Simple ways to stop doing dumb things with money. So our mission here is to really get to the core of why our own behavior is like the biggest factor in our financial success or, lack of it.
Yeah. And to help you listening see that critical difference between how an investment performs on paper
Right.
and the returns you actually get in your account as the investor.
Yeah. So we're using excerpts from the book as our guide, looking at how we trip ourselves up, why we do it.
And crucially, what we might be able to do about it, even if it's not always easy.
Okay, so let's just jump in. The whole idea, the behavior gap itself, what is it exactly?
Right. So the behavior gap, it's this difference, and it's documented. Studies consistently show it.
Uh-huh.
The average investor in, say, a mutual fund, they earn significantly less than the fund itself earned over the same time.
And not just by a little bit, right? The sources he mentions, like Morningstar, Del Bar, they show this is a big, persistent gap.
Year after year.
Yeah.
It's not a fluke. And the key thing is why. It's not usually the investment's fault.
Right, the fund just does its thing.
Exactly. The studies show it's investor behavior. We react, we get scared, we get greedy, we move money around.
Almost always at the worst possible times.
Pretty much. Buying high, selling low, the classic errors.
He gives those examples, right? Like buying stuff that's already shot up because you feel like you're missing out.
Yeah, FOMO. And the opposite, selling when things are down because you're panicked. Like in spring 2009.
Oh, yeah. Market's tanking.
Right. And he talks about clients wanting to sell after their portfolio was already down like 30%.
Which feels like stopping the bleeding, maybe, but it's the worst time.
Exactly. The damage from the drop was already done. Selling then, that just locked in the loss. It was pure fear driving the decision.
And the flip side happens too, right? Market's booming, headlines are great.
Uh-huh. Everyone feels like they should be buying more, chasing those gains, often are right before a pullback.
I love that analogy he uses in the book.
Which one?
The lawnmower. Lawnmowers don't hit sprinklers.
Ah, yeah. 10-year-old boys pushing them do.
Exactly. Investments don't make mistakes. Investors do.
And that leads to a really crucial point about responsibility. If we always blame something else, the market, the news, whatever.
We miss our own role.
Completely. And if you don't take responsibility for your choices, you're basically doomed to repeat them. That old definition of insanity, right? Doing the same thing.
And expecting different results, yeah. Fits perfectly with money sometimes.
So, okay, if behavior is the problem, what's driving it? What are these forces inside us?
The book really points to two big ones. Fear and greed.
The classics. And he makes a good point. They're not just opposites on a dial. They're distinct emotions.
Right. And both lead to bad timing. Selling low out of fear, buying high out of greed.
Yeah. And you can maybe build a portfolio to lean one way or the other. Manage for fear, be more conservative.
Right.
Or manage for greed, be more aggressive.
But not both at once.
You can't have it both ways. That's a key trade-off.
Okay, besides fear and greed, what else trips us up? There's overconfidence.
Oh, that's a huge one. And it's tricky because the people who have it most, they're often the least likely to see it in themselves.
Uh-huh. The more sure you are, the more risk you take.
Seems to be the pattern, which just magnifies the potential downside if you're wrong.
He gives that crazy example of long-term capital management. The hedge fund with all the geniuses.
Nobel Prize winners on staff.
Yeah.
Yeah. They had these super complex models.
Predicted a max loss of like $35 million in a day.
And then lost over $500 million. In one day. $553 million. And the fund eventually collapsed.
Wow. Or even Alan Greenspan, head of the Fed, admitting his models just failed spectacularly in 2008. He was shocked.
Right, so it's not just average folks. It hits experts, geniuses, everyone. That certainty can be a real liability. Makes you blind to risk.
And speaking of risk and bubbles, he mentions the greater fool theory.
Ah, yes. The idea you buy something overpriced.
Not because it's worth it.
But because you think you can find someone even more foolish to buy it from you later at an even higher price.
Like the dot-com bubble back in the day, everyone kind of knew it was crazy.
But the game was to sell to the next person before the music stopped. Find the greater fool.
Warren Buffett's quote always comes up there, right? Only when the tide goes out.
Did you discover who's been swimming naked?
Yeah.
The book really pushes you to ask yourself, am I relying on a greater fool anywhere?
And if someone looks back and sees they always seem to buy high and sell low, this losing pattern.
Yeah, getting constantly whipsawed.
The book suggests something pretty drastic.
Which is?
Maybe. Just avoid the stock market entirely.
It's provocative, but it followed the logic. It's like that old Will Rogers line.
Worry less about the return on your money.
And more about the return of your money. Sometimes protecting your capital from your own bad decisions is the smarter move.
If you know that's your pattern.
Right. Acknowledging that your behavior in that arena is just consistently destructive.
Okay, so beyond these internal things like fear and overconfidence,
Yeah.
the book also looks at how maybe some conventional approaches actually make things worse.
Yeah, like how we deal with advice and forecasts, especially from, strangers in the media.
He has a funny analogy, the friend building a beach house in Central America.
Yeah. And all the neighbors give conflicting warnings based on their bad experiences. Termites, robbers, lightning, legal fight.
Exactly. The point being, most media advice is generic. It has to be.
You can't possibly know your specific situation, your goals, your risk tolerance, your life.
And market predictions are singled out as especially useless.
Pretty much. He mentions that New York Times article from 2010 saying, take cover, get out of the market for years.
Which is just impossible advice for most people saving for retirement or college, right?
Yeah.
Your life circumstances matter way more than some generic forecast.
Totally. Tim Error's quote nails it. Personal finance is more personal than it is finance. Those rules of thumb, like always avoid annuities or whatever, maybe they have a grain of truth about fees or complexity.
But applying them blindly isn't smart.
Right. They're starting points for thinking, not rigid rules for your life.
And the track record of these forecasters, it's not great, is it?
Let's just say it's mixed,
Yep.
very mixed. He mentions Rubini getting the '08 crisis right, but other big calls wrong, and others making incredibly specific predictions.
Which, if they hit, is probably just luck. Like the broken clock.
Exactly. And accepting that unpredictability, the book argues it's actually freeing.
How so?
Well, you stop wasting energy trying to guess the future.
Yeah.
And you can focus on the only thing you can control.
Use your own actions.
Your own behavior.
Yeah.
And then there's the problem of just too much information. Drowning in data.
Oh, absolutely. In today's world, constant portfolio checks, news feeds blinking.
It doesn't make you calmer, does it?
Quite the opposite. The book argues it ramps up the anxiety. It's impossible to sort the real signal from all that noise.
He even calls it a compulsion, like an addiction. Cites that Wall Street Journal piece listing tech addiction alongside money and sex as reasons for divorce.
Yeah, it shows how this constant checking bleeds into everything and just fuels that anxiety, making you want to do something, usually something rash.
So the advice is maybe consume less.
Sounds simple, but yeah, change the habit. He tells that story about his weird rash going away after a media detox. Tuning out the noise can genuinely improve well-being. Less anxiety, less impulse to act on fear. The less I know, the better I feel, kind of thing. And acting on just one headline, like a magazine cover screaming, America's back.
Terrible idea.
Yeah.
If you sold low in panic, buying back high just because the news looks good now, you're just repeating the same bad cycle.
It's like gripping the golf club too tight, he says, or tensing up in a kayak. Monitoring constantly makes you anxious and hurts performance.
Right. And you don't need to invest like Harvard or Yale's endowment or like Warren Buffett.
Their situation is totally different.
Completely different goals, resources, risk tolerance. The key is, like the book says, you got to be you.
Okay, now, this next part is pretty provocative. He challenges the whole idea of traditional financial plans.
Yeah, this is a big one. The claim is financial plans themselves, often worthless.
Worthless. But everyone says you need a plan.
Right, but here's the distinction. The plan might be worthless, but the process of planning, that's vital.
Okay, explain that. That sounds like a contradiction.
It does at first. But think about a traditional plan. It relies heavily on assumptions about the future, right? Inflation, market returns, how long you live.
Stuff nobody actually knows.
Exactly. These guesses are necessary for the spreadsheet, but they're guaranteed to be wrong. You plan, God laughs.
And life just throws curveballs anyway. He shares those stories. His Vegas real estate deal collapsing.
Friend's business value cratering overnight.
Mm-hmm.
Another friend inheriting money and losing it all day trading.
So the plan becomes obsolete fast.
Or worse, it becomes what he calls retirement story hour.
Uh-huh. What's that?
It's where you just keep tweaking the assumptions in the spreadsheet, lower inflation, higher returns, retire later until the numbers on the paper look okay.
But nothing actually changes in your behavior.
Right. It's just fakery if it doesn't impact how you save, spend, or invest. It's not based on reality.
So the value is in the process.
Yes. A reality-based planning process, one that accepts unpredictability. It means making decisions based on what's actually happening now.
Not based on rigid hopes or fears about a future you can't predict.
It gives you permission to let go of needing perfect, long-term precision. It's like climbing a mountain. You set a general course.
But you expect to adjust based on weather, terrain.
Exactly. You know you'll need to make course corrections constantly. The plan isn't the map you rigidly follow. It's the framework for making decisions as you go.
So maybe focus more short-term, like the next few years.
That's the suggestion. Plan for the next 3 years based on current reality.
Yeah.
It keeps you grounded in the present, where you can actually act based on awareness, not guesswork, about 20 years from now.
And he also challenges that idea that risk just goes down smoothly over time.
Right. The percentage range of returns might narrow over decades, yeah.
Yeah.
But the potential dollar outcomes, the gap between a really good result and a really poor one,
That gets wider.
dramatically wider over time. Think about that flight analogy he uses.
LA to Miami. A tiny error leaving LA isn't a big deal over Vegas.
But if you don't correct it, by the time you get to the East Coast, you could be in Maine instead of Miami. Small return variations compound massively in dollar terms over decades.
Okay, so if the big picture economy, markets, is largely uncontrollable,
And the long-term plan is guaranteed to be wrong.
where should you focus your energy?
On your personal economy, what you save, investing in your own skills, your business, working hard, things you actually influence.
Like that Jim Rogers quote he mentions.
About saving, investing, and working hard, winning out over consuming and borrowing.
Yeah. Forget obsessing over China or gold prices.
Focus on what you can control. He tells that great story about his friend borrowing $19K for therapy.
Sought it as an investment in himself.
Exactly. And that investment in his well-being let him leave a bad job and become a successful author. That $19K likely had the best ROI of anything he ever did financially because it changed his behavior and his life path.
Wow. And ultimately, this all comes back to the why, doesn't it? Connecting money to life, to goals.
The real purpose isn't just the money itself. It's usually happiness, providing for loved ones, the things money enables.
He brings up that Kahneman and Deaton study. Money boosts happiness up to a certain point.
Around $75K a year in the U.S. back then. It relieves stress, buys basics and some comfort.
But beyond that, more money doesn't automatically equal more happiness, doesn't fix deeper needs.
Right. And trying to keep up with the Joneses, that constant comparison, the book says that's a guaranteed way to be less happy.
This is where that financial life planning idea comes in, from George Kinder.
Yeah, it's about figuring out your deepest goals first, using those 3 powerful questions.
Okay, what are they again?
First, imagine you're totally secure financially. What would you do? How would you live? Second, imagine you only have 5-10 years left, but you feel fine. What changes?
Okay.
And third, you have only 24 hours left. What matters most? What did you miss? What regrets?
Wow. Those are deep.
And the answers usually aren't about hitting a certain portfolio number. They're about relationships, experiences, creativity, authenticity.
So the idea is your financial decisions should line up with those answers.
Exactly. Use money as a tool to fund what truly matters to you.
Another trap he points out is the urgent versus important thing.
Oh, yeah. We get buried in the urgent daily stuff, emails, chores.
And the important but not urgent things get pushed aside.
Like financial planning, updating your will, consistently saving. He uses that example of people scrambling to do wills right before a trip.
And then forgetting until the next trip.
Right. The simple fix. Schedule time for the important stuff. Treat it like an appointment you can't miss.
And again, don't make big decisions just reacting to the news or thinking there's some secret in a magazine article.
Right. One news item shouldn't derail your whole approach. You only control your own behavior. The idea that some secret to wealth is just printed for everyone It's kind of silly when you think about it.
Money's just a tool, ultimately, not a scorecard, not a happiness guarantee.
Exactly. Wisdom, health, experiences, love, those are vital too. And the book makes this great point. Acting in your true financial self-interest means spending less time worrying about money.
And more time nurturing those deeper parts of life. That sounds paradoxical.
But it makes sense. If you know what truly matters, your financial goals become clearer, and you're less likely to chase things that don't actually serve your real life.
Okay, so wrapping this up. How do we actually bridge this gap, make better decisions? He says it's simple.
But not easy. That's the crucial part.
It's a contradiction, right? We say we want simple.
But we often choose complex. Why? Maybe because simple requires changing ourselves, our behavior,
It's easier to look for a complicated fix outside.
than to do the simple, hard work on our own habits.
Yeah. Simplicity is the ultimate sophistication, he notes, like expert climbers or simple health advice.
People sometimes want a complex diagnosis, not just eat better, sleep more, because that requires discipline.
And basic financial success is like that. Simple, but requires discipline.
Incredibly simple, really. Save consistently, avoid dumb speculation, repeat, for a long time.
Not sexy. Not a fairy tale.
No, but it works. It just needs patience and discipline, not chasing complexity.
But our culture fights against that, right? With instant gratification.
Oh, constantly. Amazon Prime, he mentions.
Yeah.
News cycles. We're trained to be consumers, wanting it now.
Even after a crisis like 2008, people snapped back to old spending habits.
Yeah. It connects to that marshmallow test research. Delaying gratification is key to success. Saving feels boring now.
But achieving the goal later feels amazing.
Right. So he offers simple tricks. A 3-day waiting period before buying stuff. A spending fast. Tracking where money goes.
Putting price tags on goals, thinking about opportunity costs.
All simple ideas.
Yeah.
But doing them, that's the not easy part. Requires behavior change.
And the big secret to wealth
Is that there is no secret. It's usually doing boring things consistently. Like the guy who bought boring things and paid them off over 30 years.
which leads to his idea of slow and steady capital.
Yeah, a philosophy focused on avoiding big losses rather than chasing huge gains.
Trading the chance of making a killing.
For the assurance of not getting killed by your own mistakes or speculation?
Which lets you ignore the noise. Jim Cramer versus trail running.
Exactly. Focus on the long game, funding your actual life goals. It's boring short-term, maybe.
But exciting long-term because it works. Unlike the person bragging about recent wins but having a terrible long-term record from big blow-ups.
Right. And that really brings us back to the core message. This book isn't specific advice for you. A stranger can't give you that.
It's more like a mirror, a framework for self-reflection.
Yeah. And the first step is just admitting the problem exists, looking honestly at your past mistakes,
Tech bubble, real estate, selling low, whatever your pattern is.
and identifying your behavior gaps. Without blame.
Yeah.
Just learn from it and move on.
Because ultimately, the market, the economy, specific stocks, mostly out of your control.
Even the best plans will be wrong about the future.
So, does that mean we're powerless? If everything's unpredictable and out of our control?
The book argues the opposite. It's liberating.
How so?
It frees you up. Stop chasing the uncontrollable. Put all that energy into the only thing that truly determines your financial well-being and happiness.
Which is?
Understanding and controlling your own choices, your own behavior. One simple, difficult decision at a time.
So, consider this. What single simple choice about your money will you focus on today?